What's up, everybody? Day 2, 4-minute finance. Let's get right into it. Pre-tax versus post-tax contributions into your 401k with your employer, or an IRA, traditional IRA versus Roth IRA, same underlying concept, different limits on how much money you can put into each. Today we're just going to talk about the tax consequences. So, pre-tax contributions into a 401k. Those would be contributions into that vehicle that are going to be before tax. For example, right, make a $100,000 salary. Let's imagine you're putting 10% contributions into your 401k. The IRS is going to tax you on $90,000 of income rather than $10,000. Okay, that money is going to grow tax deferred, so it went in tax free. It grows tax free. On the back end in retirement, when you take distributions, you will pay income tax on those dollars then. Okay, post-tax, Roth contributions. Okay, post-tax meaning after tax. You make $100,000, you make 10% contribution. The government is going to still view that as you making $100,000. $10,000 goes in. You already paid tax on those dollars. They grow tax-free. In retirement, they come out tax-free as well. So a lot of clients are asking, well, what's better? What's more beneficial for me? Okay, well, what we're looking at, or what the really deciding factor is what's going to have the higher tax consequence, right? What is going to net out more money in my pocket? That's what clients want to know. So what does that come down to? It comes down to two factors, right? Because your tax bill is going to be based on how much money, what is your income in a given year, and what are tax rates, what are tax brackets in a current year. Okay, so we're making some assumptions there. Obviously, myself and the other individual in the world, regardless of what they may say, does not know what tax brackets will be or what your income will be at retirement or during distribution of these assets. Okay, so you need to make some assumptions, right? Do you think your income is going to be higher today or higher down the road? Okay. Number 2, do you think tax brackets, your tax rate is going to be higher today or down the road? Okay. Some things we don't know there. Looking at your own situation, talking to a professional is going to help you really look at that and think through that in a little bit more detail. But yeah, those are the things factored in. If they stayed exactly the same, if your taxable income today is exactly the same as it is down the road, and tax brackets are the same today as they are down the road, it would not matter if you paid the tax up front or if you paid the tax on the back end. The net amount, the actual amount that you would have dollars in your pocket to spend would be exactly the same in either situation. Okay? So if you are still struggling to know your situation well enough to say which is going to be more beneficial one way or the other, what I would encourage you to do is split those contributions. If you have a 401k with your employer and they provide a post-tax contribution option and a pre-tax contribution option, if you want to save 10%, save 5 and 5. Okay? Do be aware as well, though, something to think about. If there's a match, if your company or your employer is also making contributions to that account, all of those contributions are on a pre-tax basis, meaning that they're contributing pre-tax, right? So if they're giving you 5% and you're only putting in 5%, I may tell you, hey, if we're going to split that, quote unquote, put all your 5% post-tax because theirs is pre-tax. Hope that helps. Hope everyone's having a good day. The 4 minutes is up. Feel free to comment, subscribe, like. There'll be some things in there that I'll be addressing in future videos. If we don't have understanding of tax brackets or income or how things will work, I'll be following up. Take care.